all the faculties and dear students present here today. I, Mansi Gohil, Assistant Professor, Parul Institute of Commerce, welcome you all to the webinar series of Parul Institute of Commerce. Today we have with us Dr. I. Siddiqui, Head, School of Commerce, Sri Saraswati Thayagraj College. He has over 21 years of experience in academics. He has done his PhD in the year 2014 and also have cleared national eligibility test. He also has received grants for various UGC and ICSSR projects. Also has good hand on research. So today he is going to share his knowledge on how to compute income from salary in a simplified way. So we welcome you, sir, from Parallel Institute of Commerce.
Thank you. Thank you, Manchikove. So my voice is audible?
Yes, sir. Perfect.
Yeah. Thank you. So let me start our program, madam. Let me start our class. So my voice is audible, sir? Audible, please.
Yes, sir.
Ma'am, let me start.
Yes, sir, it is audible. You can just open your PPT which you want to share.
Yeah.
Okay.
So PPT is visible, ma'am?
Yes. You can have a full screen over here. Sir, we can start.
Yeah, thank you, madam. Thank you for the opportunity given by Nancy, ma'am, and the whole Parallel Institute of Commerce. So the topic I'm going to discuss today is so income from salary, a simplified approach. So how we are going to calculate the salary. So what is the amount you are going to pay tax to the government? So before going to the topic, first we have to discuss about tax. So what is meant by tax? So already know tax is a compulsory contribution made by individual. So it's the individual contribution to the government. The amount exceeds the exemption limit which is fixed by the government. If your total income, if exceeds the exemption limit, for example, the exemption limit is fixed by the government now, today is 2,50,000 rupees. If income is exceeds your exemption limit, you have to pay tax to the government. You have to pay tax to the government. So it's a compulsory contributions. You didn't get any return. Suppose you go to the provision shop, you go and buy something, you can give money, you can buy something, or you can get return, you can get benefit from your paying. But you are paying tax, you didn't get any benefit, didn't get any benefit. So this is the tax. This is the meaning of tax. So tax is a compulsory contribution made by the individual to the government. So government can use this tax for public welfare. They can use it for a public welfare. What is public welfare? They can use it for public welfare expenses. So government can use this particular tax revenue to spend for defense. So they have to allocate a certain amount of money from tax for public welfare and health. They can use the tax revenue for road construction. So this is the way the government using tax revenues, the tax revenues which are collected from the public, which are collected from the public. So, okay. In taxes, there are two types of taxes. One is direct tax, another one is indirect tax. So direct tax already know, so everybody is knowing. So it is directly charged from the public, from the assessee. You have to take from the assessee. So assessee, a person who is liable to, so assessee means a person who is liable to pay tax to the government. So direct tax, it is directly charged from the public. Indirect tax, it is indirectly charged by the government from the public. For example, you have to take GST. So daily you are using, for example, you are using toothpaste, but indirectly the government is collected tax from that particular product. So that is called indirect tax. We are paying GST. Suppose you can drink a tea, you have to pay tax to the GST to the government. So it is indirect, it is indirectly collected by the government. So this is called indirect tax. This is called indirect tax, my dear faculty members and my dear students. So there are two types of tax. One is direct and another one is indirect tax. So direct tax, the first example is, so employees, they are getting salary from the employers. So salary, it comes under the direct tax. Suppose you are having a lot of houses, your own houses are there. You can collect rent from the tenant. You are the owner of the houses. You can get rent from the tenant. So this is the revenue for you. You have to pay tax to the government. So it comes under the direct tax, my dear students, my dear faculty members. So my voice is audible? Ma'am, my voice is audible?
Yes, sir.
Yeah.
It is audible.
Yeah, thank you. So, okay. So direct tax, example is you have to take income, salary, income from other sources. So these are these incomes which are comes under the direct tax. So indirect tax, it is indirectly collected from the public by the government. So, okay. So now I'm going to enter the topic, my dear students. The topic is income from salary. So my dear students and faculty members, so final year students have already got appointment from the reputed concerns. We are going to get a salary from the reputed concerns. So how we are going to pay tax? How you can calculate the tax for your salary? That is we are going to see now. That is we are going to today. We are going to see now. So how the salary people are pay tax to the government. So what is the procedure? What is the provisions are there? What is the rules and norms which is fixed by the government? That is we are going to see today, my dear students and faculty members. Okay. So I am Dr. I. Siddiq. I'm working as a head of the School of Commerce, Sri Saraswati Tyagaraja College, Pollachi. Pollachi, it is situated near Coimbatore district. So Coimbatore district, it comes under Tamil Nadu. It's a district of Tamil Nadu. Okay. So now we are seeing the direct tax. In direct tax, there are 5 heads of income. There are 5 heads of income. The first income is income from salary. The second income is income from house property. The third one is income from business, or we are saying it's a profession. Income from capital gain. The last one is income from other sources. So this is 5 heads of income. So these 5 heads of income comes under the direct tax. The first topic I'm going to discuss today with you. The first topic is income from salary. So already you know this is the first head of income. the section, the Income Tax Act is there. The Income Tax Act is 1961. In 1961, section 15 is there, 16 is there, and 17. 15, 16, and 17, these sections are deals with income from salary. Section 15, it deals the chargeability. So chargeability is, what is the chargeability of allowances? What is the basis of charge for perquisites? What is the basis of charge for a provident fund? So section 15 deals with the chargeability. Section 16, it deals with the deductions. Section 16, it deals with the deductions. So you are getting income. So you are getting salary income. So what are the deductions are there? So after deductions, you have to pay your tax. So you are having income, you have to deduct the deductions. So I will discuss one by one. You don't bother, my dear students. So we can deduct the deduction. So finally we can compute the taxable salary. So that is the amount we are going to pay tax as tax to the government. So section 17 deals with about the definitions. Okay. So salary. Okay. The next is, so before going to analyze the income from salary, so you should know the important definitions. You should know the important definitions. So this is very, very important, my dear students and faculty members. The first one is assessee. Who is an assessee? The second one is, what is previous year? The third one is, what is assessment year? The first one is assessee. Suppose your income exceeds the exemption limit. You are having a liability. If income exceeds your exemption limit, you have to pay tax on your income. So this is called assessee. So assessee is a person who is liable to pay tax on his income which exceeds the exemption limit. So present day or now, the exemption limit is up to rupees 2,50,000 rupees. In India, my dear students, listen. So this is very, very important data. In India, 95% of the rural and semi-urban population, their earnings is below 2,50,000 rupees. Their earnings is below 2,50,000 rupees. So this is unimaginable. So okay. So assessee, a person who is liable to pay tax on his income, he is called an assessee. Suppose you are paying tax to the government, saying like, so today onwards you are called as an assessee. You are called an assessee. So assessee, as usual, we are classified into three: ordinary assessee, deemed assessee, and assessee in default. The first ordinary assessee, as usual, ordinary assessee, we are termed as representative assessee also. Ordinary assessee, as usual, a person who is liable to pay tax on his income, he is an ordinary assessee. So he is comes under the Income Tax Act. He is called an assessee. The next one is deemed assessee. Who is a deemed assessee? A person is liable to pay tax on another person's income. So he is not paid tax on his own income. So he is paid tax on another person's income. How it is possible? Yes, it is possible. Guardian of minor. So minor, he is having income, but he is not eligible to pay tax, but his guardian is paid to tax. So example is the guardian. Next, guardian of lunatic. He is called deemed assessee. The next category, assessee in default. A person, fails to fulfill his statutory obligations. A person is not paid tax to the government, but he is having the income, but he is not paid tax to the government. So he is called assessee in default, but it is a mandatory, he has to pay tax to the government. So he is called assessee in default. So this is the classification of assessee. So ordinary assessee, already know you are having income, you have to pay tax to the government, you are an ordinary assessee. So deemed assessee, so already I know, so a person is eligible to pay tax on another person's income. So I have given an example, guardian of lunatic, guardian of minor, etc. So assessee in default, a person, he is fulfill, he is fails to fulfill his statutory obligations. He is called assessee in default. The next term you should know, that is called the previous year. So current previous year is 2021. Current assessment year is 21-22. So what is the difference between these two? Very, very simple. So previous year is otherwise known as financial year. We are saying financial year. So already you are all commerce graduate, already know it starts from April and ends with March. So 12 months period. So assessee can calculate what is the 12 periods his own income. He has to calculate his own income for the these 12 periods from April to March. So this is called previous year. So previous years we term it as also income end year. So what is your income for that particular period? So this income you have to pay the tax for the next year. So that is called, my dear students and faculty members, assessment year. That is called assessment year. So assessment year is a tax payable year according to me. So I have given some definitions. Assessment year is a tax payable year. So that year you have to pay tax to the government. So previous year is the income earned year. What is your total income? So you have to assess your total income. For that income, you have to pay tax for the assessment year. So that's why I coined a name for succeeding the previous year. Succeeding the previous year. So this important change, this important difference, so first you should know. So assessee, a person is liable to pay tax. Previous year, already know, it's a period commencing from April and ends with March. Assessment year, it is also commencing from April and ends with March. So previous year, so you have to assess your total income. For that total income, you have to pay the tax for the assessment year. So this is the important terms. Everybody, every salary employee, you should know this important terms. So my dear students, next we are going to see the topic salary. Salary, any emoluments. So any emoluments, it may be, you can received as an amount. You can receive some benefit, you can receive some compensation. So that is, we are saying emoluments, any emoluments received by an employee from the employer for the services rendered to the organization or institution. So you are going to work for the institutions, or already you are working in a particular, you are working in an institution, or you are working in an industry, or you are working in a institution. So you are getting a salary. So it involves allowances, provident fund, profit in lieu of salary. The next one is perks. Perquisites are saying it's a perks. So allowances. So lot of provisions are there, but I have taken only 4 provisions. So as a basic employee, you should know these 4 components of salary. You should know these 4 components of salary. The first one is allowances. The next one is the provident fund. The next profit in lieu of salary. So allowances, you know, so basic pay, you are getting a basic pay. So basic pay is fixed by the government or fixed by the private employee. So based on the qualification of an employee. So an employee is in illiterate, the salary is different. An employee is completed 8th, their salary is different. The employee is completed 10th, their salary is different. The employee is completed graduation, the employee is completed post-graduations, so their salary is totally different. So this is allowance. So allowances, it means allow something by an employer to an employee is called allowances. So provident fund. So you know the provident fund. So in provident fund, it is a savings for the employee. It is savings for the employees. So both the employer and the employee can contribute this provident fund. So this is a provident fund. Both the employer and the employee can contribute. So employer, they have to contribute 12% of salary. Employee can contribute 12% of salary. The total 24% of salary is as savings for you. It can be retrieved or it can be extracted or it can be withdrawn at any time. So this is called provident fund. So next one is the profit in lieu of salary. So apart from salary, so some employees can get a lump sum amount or a huge amount they are getting. So that is called a profit in lieu of salary. For example, you have to take gratuity. So you are working in institution for the so 5 years. You have working in institution for the 5 years. You are eligible to get a gratuity for your loyal services. You are providing loyal services to the particular company. So you are eligible to get gratuity from that particular institution or that particular industry, whatever it may be. The next one is perks. Perks is extra benefits. You can get extra. For example, you have to take, you can buy a bike, you can get extra miles. So extra benefits. So apart from salary, so the employer can provide car to an employee. So it is an extra benefit. Sometimes it may be received by way of cash or sometimes it may be received by way of kind. Car. So employer is providing car to an employee. The next one is house. House is provided by an employer to an employee. So first, suppose you have to calculate your salary income. First, you should know these 4 components of salary: allowances, provident fund, profits in lieu of salary, then perquisites. So allowances, I can classify it into fully exempted, fully taxable, and partly taxable. I will explain later. So slides are coming now. Okay. Madam, my voice is audible, please.
Yes, sir. It is audible.
Yes. Thank you. Okay. So how we can calculate the salary as per income tax norm? So how you can calculate the salary? So you go the Google Chrome or you go to the Google. You can search salary calculation. So separate calculator is there. Separate calculator is available in the Google. You go and search it. You can get these data. So what is your basic pay? What is your DNS allowance? What is your fully and partly taxable allowances? So first you have to, so this is for, we are calculating tax for the whole year. Already I told you, for the 12 months period we can calculate. So basic pay you're getting per month, you can convert it into 12 months. DNS allowance you're getting per month, but you can convert it into 12 months. So we can calculate the taxable salary for the whole year. So basic pay, DNS allowance, fully and partly taxes. So first allowance is over. The next, I already told you the 4 components. The second component is provident fund. So provident fund, there are different types of provident funds are there, my dear students and faculty members. One is SPF. SPF is, we are saying, statutory provident fund. RPF, recognized provident fund. So PPF is there, that is public provident fund. The fourth one is unrecognized provident fund. So SPF, Statutory Provident Fund, is applicable to the government employees. It's applicable to the government employees. So they are getting the so they are eligible for a statutory provident fund. The next one is RPF, Recognized Provident Fund. It is applicable to the private employees. You are working in a private institution, so you are eligible for Recognized Provident Fund, but you are not eligible for statutory provident fund. The next third one is PPF is there. I didn't mention. So PPF is Public Provident Fund. Any self-employed people can contribute this Public Provident Fund. Anybody can contribute PPF. The next one is Unrecognized Provident. This is also anybody can contribute this fund. So you are having an income, you are having a sufficient income, so you have to invest certain amount of money in PPF, in Unrecognized Provident Fund, in apart from SPF, RPF, you can invest in PPF and Unrecognized Provident Fund also. So here, already I told you, Provident Fund, both employer and the employee can contribute. But here we have to take only employer for taxable purpose. Here we have to take only employer's contribution. So what is that? Because employee contribution, it is not an income, my dear students. It is an expenses. It is actually it is a savings, but we are telling expenses. So you are that is your savings. So suppose employer can contribute for your savings, that is income for you, so that we have taken into account for computation of income from salary. The next one is, so already you know it is a savings. Every year minimum at least 24% of salary is contributed by both employer and employee. So it is a savings. So after 5 years, after 3 years, after 4 years, a huge amount you have deposited in public provident fund. So the provident fund organizations, they are giving interest to you. That interest, it is an income for you. You have to pay tax. But they are giving certain exemption. Less 9.5% interest is exemption. They are giving 9.5% of interest is exempt. You are getting 13% interest, 9.5% interest is exempted. You have to pay the remaining 3.5% as the tax to the government. It is comes under the income from salary. Okay, so this is second point, provident fund. So the third. So allowance is over. The second provident fund is over. Third one is provident lieu of salary. So a lot of items are there. While corporate income salary, you can get advance salary is there, real salary is there, bonus is there, fee is there, commission is there. All the items are there, but I didn't touch them. So what is important? That is I'm going to discuss. So these four components are important that I have to discuss with you, my dear students. Okay. The third one is profit in lieu of salary. There are three components under this heading. The first one is the gratuity. The second one is pension. The third one is leave salary. Okay, that's all. So we are going to discuss one by one. The fourth item, perks. So you can add these four components. We are getting gross salary. You can get the gross salary. So after gross salary, you have to deduct three items. One is standard deductions. It is fixed by the government as 50,000 rupees. It is fixed by the government as 50,000 rupees. The next one is second component for deduction is deduction for entertainment allowance. So this deduction for entertainment allowance applicable only for the government employees, not for the private employees. So private employees, suppose they are receiving any entertainment allowance, which is given by the company, which is given by the institution, that is taxable, fully taxable. That should be included in gross salary, not included in deductions. So private employee, it is fully taxable. So this deduction for entertainment allowance 6 and 16 subsection 2 is applicable only for government employees. The last deduction is the deduction for professional tax. So this is the third deduction. So after gross salary, you have to deduct three items: standard deduction, deduction for entertainment allowance, and deduction for professional tax. So we can get the taxable salary. We can get the taxable salary, my dear students. The next. So we can see one by one. So this is the basic. Suppose you go and search. Suppose you want to pay tax to the government, you go to search. These items are available in the website. Suppose you go to e-filing your return. You are having income. You are going to e-filing your return. So these informations are available. So you can directly fill it. That's all. So that's why this webinar have been arranged. So allowances, there are allowances. It can be classified into three. One is fully exempted, another one is fully taxable, the third one is partly taxable allowances. So fully exempted allowances. So fully exempted, it means you are not pay tax to the government. It is fully exempted. You should not pay tax to the government. It is fully exempted from tax. So I have given example to you. The first one is foreign allowance for the government employees, those who are posted outside India. So government employees, some employees, they have posted outside India, they have to work, they're working there, they're getting some allowance that is called foreign allowance. That foreign allowance is fully exempted. So you may not pay tax to the government. So house rent allowance given to the judges of High Court and Supreme Court. Supreme Court and High Court judges, they are receiving house rent allowance. That is also fully exempted. Sumptuary allowances, it is also given to the judges of High Court and the Supreme Court. So they have to spend a certain amount for entertaining the visitors. So visitors already, they are judges. So visitors are there. Visitors, they are regularly meet them. So they have incurred some expenses. That allowance is called sumptuary allowances. The next one is allowances from UNO. So international organizations, they are giving certain allowances to you that is exempted. So allowance is given to member of UPSC. So UPSC, suppose you are a member of UPSC, Union Public Service Commission, you are a member, you are getting some allowance. That allowance is fully exempted from tax. So fully exempted, you should not take into account. That's all. So it is not comes under salary calculation. So fully taxable allowances. The next one is fully taxable allowances. So a lot of allowances: dearness, city compensatory, tip and lunch, marriage, family, project, overtime allowance, deputation allowance, wardenship allowance, water and electricity allowance, servant, holiday trip allowance, fixed Medicaid allowances. So you can receive these allowances. You have the whole amount is taken for salary calculation. Suppose basic pay already know DNS allowance. Suppose a particular employee is receiving city compensatory allowance. So cost of living is higher in that particular places. So the company is giving city compensatory allowance. So some companies, they are giving tiffin allowances. Some companies, they are giving lunch allowances. Some companies, they are giving marriage allowances also. You have to take Wipro, you have to take Infosys, they are giving marriage allowances. Family allowance. So these allowances are taxable under the head income from salary. So we have to take the whole amount, whatever the amount you have received, that should be taxable. The next one is partly taxable allowances. So you have to pay certain portion as a tax. What is the portion? It may be 50, 40, it may be 20, 30, it may be 80, 20. No. So the provisions are there. So income tax authority, they have framed certain norms. They are framed certain provisions for this partly taxable allowances. House rent allowance is there, entertainment allowance is there, helper allowance, uniform allowance, convenience allowance, traveling allowance, academic allowance, daily allowances, skill compensatory allowances. So employees, those who are working in hills area, they are giving skill compensatory allowances. Transport allowances is there. So lot of nearly 110, nearly 110 or 111 allowances are there, but I have taken only few. I have taken only few. So okay, sorry, local languages coming, don't mistake me. So fully exempted, you should not take for salary calculation. Fully taxable, you have to take the whole amount. Partly taxable, you have to take a part of the amount. You have to take the part of the amount. So provision is required only for this partly taxable allowances, my dear students and faculty members. Okay, next we are going to see in partly taxable allowances, I'm going to see few allowances. I'm going to see only 3 allowances that you have to remember always. The first one is house rent allowance. Again, it can be classified into 3. So this allowance is received by the judges of Supreme Court and High Court. It is fully exempted. Already we have seen in the previous slide. The next one is received by an employee living in own house. An employee is living in a own house, but he is receiving house rent allowances. It is fully taxable. So he is living in own house. So he didn't spend anything for his house because he is living in his own house. But he is receiving house rent allowance. It is fully taxable. The next one is received by an employee living in rented house. House rent allowance received by an employee living in rented house. Suppose an employee is living in a rented house, it is partly taxable. A portion of the amount he has to pay tax. Okay, next. Madam, my screen is visible to you?
Yes, sir, it is visible.
Yeah, thank you. Sir, how we are going to? So, it is fully exempted. You need not pay tax. It is fully taxable. Here we have to take the whole amount. Here, the part of the amount you have to pay tax, house rent allowance, so partly taxable. So what is the provisions are there? That is we are going to see now. Yeah, this is taxable portion of house rent allowance. So employees, those for this provision is applicable to employees, those who are living in a rented house. Employees, those who are living in rented house. So house rent allowance received. Let's say exemption. There are 3 items. One is actual. What is the amount he has received? That you have to put it for the calculation. The next one is rent paid. He's already I have explained. So he is living in a rented house. He has to pay certain amount as rent to the owner. So that rent paid you have to take into account. Then minus 10% of salary. So salary. So what are the items we had? So salary already I told you it has a 4 components. What are the items we have taken into account for salary calculation here? So you have to take only 3 items. That is basic pay you have taken. So DA, the DA. So so government or the private institution, they are giving for retirement benefits. They are giving for retirement benefits that you have taken into account. Then commission. So ordinary DA is there. So DA farming is there. There are 2 types of DA. So ordinary DA farming is there. So this DA farming is paid for retirement benefits. Is paid for retirement benefits. That DA you have taken into account. The next one is commission. It is based on the fixed percentage. It is based on the fixed percentage. So these three items we considered as a salary. In total of this salary, you have to take 10% that you have taken into account. The next one is 40 or 50% of salary. So 50% of salary is applicable to 50% of salary is applicable to employees, those who are working in metropolitan cities like Delhi, Mumbai, Kolkata, and Chennai. So this is the metropolitan cities. Those who are working in these area, HRA. So you have to take 50% of salary. So 50% of salary here. So for other states, so I'm living in Coimbatore district, I have taken only 40%. So somebody, those who are living in Aurangabad, so you have to take 40% of salary. Somebody is living in Gujarat, so you have taken only 40%. Somebody, those who are living in Delhi, so here you have to take 50% of salary. So salary, already I told you, you have to take three components: basic pay, DA, commission. So based on, so you have to take these components and add it, and you have to take 50%. So these three components, out of three components, you have to take whichever is less. Whichever is less is a taxable portion, is exempted portion, sorry, is exempted portion, is exempted portion. Finally, we can get the taxable portion of HRA. So this is very important calculation, my dear students, my dear faculty members. You should know this, the taxable portion of house rent allowance. So the next one is children education allowance. Children education allowance. It is a partly taxable allowances, which comes under partly taxable allowances. So employees are those who are having a children. So employer can provide, can facilitate the children of the employees. What way? They are giving children education allowance. Employers are giving children education allowance to their employees. Employer can give children education allowance to their employees. So as usual, what is the amount you have received from the employer? Less exemption. Rupees 100 per month per child, but the maximum children is 2 children. So they're allowing only for 2 children. They're allowing only for the 2 children. So maximum 2 children. So what is the amount you have been received as children education allowance that you have taken into account? Less 100 per month. Suppose an employee is having 3 children, but it is restricted only for the 2 children. But it is restricted only for the 2 children. So you can deduct 100 rupees per month. So for the year, you can get exemption 1,200 per child. For example, suppose you are having a 2 child, you can get 2,400 per month. So after deduction exemption portion, you can get taxable portion. The next one is hostel expenditure. This is also an important expenditure. This is also an important allowance, hostel expenditure allowance. So what is the amount you have been received? Let's say exemption is rupees 300 per month, as usual norms for children education. So maximum, it is restricted to only for the 2 children. The remaining, the rest of the portion is taxable portion. Okay. Allowances part is over. Next, we are going to see provident fund. So allowances, please keep remaining the 3 points, my dear faculty members and my dear students. Fully exempted, you should not consider. Fully taxable, you have to take the whole amount. Partly taxable, you have to take the part of the amount as tax. For that, some provisions are there. In partly taxable allowances, you have remember 3 allowances always. The first allowance is house rent allowance. The second allowance is children education allowance. The third allowance is hostel expenditure allowance. The next item is provident fund. So I already told you it can be classified into 4. The first one is statutory provident fund. So it is eligible. The eligible employees for statutory provident is government employees. So government employees are eligible for statutory provident fund. For employer contribution, so employer contribution to statutory provident fund is fully exempted for the government employee. Employee contribution. So already I told you, so both the employer and the employee can contribute to the provident fund. Actually, it is a savings. So it can be received by an employee at the time of retirement or other some other occasions. Some other occasions it means some, suppose on the marriage, so daughter's marriage, son's marriage, or employee marriage, whatever it may be. You can withdraw the amount. Suppose you want to construct your house, you can withdraw the amount from the provident fund. So the provisions are there. So both the employer and the employee can contribute. So for especially statutory provident fund, it is exempted for government employees. It is exempted for the employer. So employer contribution is exempted. Sorry, employee contribution. So employee contribution is also comes under deduction under section 80C. 80C. So you can show it as a deduction. It has a deduction. So okay. Next one is provident fund. Provident fund. The next provident fund is recognized provident fund. So private employees. This provident fund is received by private employees. So here we have to take employer contribution only. So employer's contribution to provident fund, what is the amount he has received? Less exemption is a 12% of salary. Exempt is 12% of salary. The exemption part is the 12% of salary. Salary, as usual, I already told you there are three components you have to take into account. The first one is the basic pay, DA, farming, and commission. So you have to take these three components, calculate 12%, that is the exemption portion that you have deducted from the employer contribution. You can get taxable salary. That's all over. So this recognized provident fund is applicable only for the private employees, my dear students and faculty members. So actually it is a savings. You are getting interest also from the employment provident fund, employees provident fund organization. You can get interest. So that interest, what is the amount you have been received as interest? That exemption part is 9.5% as interest is the exemption part. That you have to deduct. We can get the taxable portion. So these two items. So only the RPF comes under the taxable salary calculation. So provident fund, you keep remaining this or recognized provident fund. Those who are living in, those who are working in private organization, please keep remaining this. Suppose you are going to work in Wipro, you are going to work in Infosys. So employer contribution is there, employee contribution there. So RPF, recognized provident fund is there. So the exemption portion, please note it down. This is 12% of salary for employees contribution. The interest, you are getting interest from the organization. That exemption is 9.5% interest. The next. So provident fund is over. The next one is profit in lieu of salary. There are three items. One is gratuity, another one is pension, and another one is leave salary. Okay, gratuity, actually it's a lump sum amount. It's a lump sum amount received by an employee, for some occasions. Suppose he want to shift from one organization to another organization, so he has been associated with the particular organization for the 5 years. You are eligible to get for graduate. The particular employee get eligible for gratuity. So gratuity is a lump sum amount received by an employee at the time of retirement or some other occasions. For he is providing for loyal services to that particular organization. Graduate. Suppose he is received government employee. The graduate is received by a government employee. It is fully exempted from tax. But The private employee is received gratuity from the employer. It is partly taxable. You have to pay a part of the amount. So that is employees covered by the POGA Act. So POGA, it means Payment of Gratuity Act. So employees not covered by the Payment of Gratuity Act 1972. So gratuity, suppose if you are an employee, private employee, you have to, which category you are comes under? You are comes under the POGA Act, you are not comes under the POGA Act. That you have to remember. That you can remember always. So what is covered by POGA Act? What is not covered by POGA Act? So covered, so employees, those who are working in large scale industries. For example, I already told you, employees, those who are working in Johor companies, it's a large scale undertaking already, know. So textile industries, those who are working in textile. So these all comes under the POGA Act. The employees not covered by POGA Act is, so employees, those who are working in a shop and establishment, small shops. So minimum 10 employees, they're working in a particular organization. So these guys comes under the employees not covered under the POGA Act 1972. So what is the provision? Now we are going to say. So as usual, what is the gratuity amount you are receiving? Exemption quote is actual. What is the amount is received? A statute limited is 10 lakhs. 10 lakhs. So it was. Suppose if any amount you are receiving gratuity from the previous employee, that you have to deduct it from the statute limit. Suppose so this is the second organization I'm working in a college, but I already received gratuity from the previous organization. Suppose I received rupees 1 lakh, so 10 lakhs I have deduct this 1 lakh from the 10 lakhs. So the total statute limit is restricted to 9 lakhs. So next one is 15 days salary into years of salary, years of service. 15 days salary, it means average salary. Average salary. So salary here you have to take basic pay and DA alone. Basic pay and DA alone. You have taken into account and calculate. For example, what is the last month's salary? So gratuity, suppose you are leaving that particular organization, so you are going to apply for the gratuity. So what is the last month's salary you are receiving? You have been received that particular organization, that salary you have taken into account. For example, I am receiving 50,000 rupees from the previous employer. That 50,000 divided by 26 into 15 days, that is average salary. That is 15 days salary. 15 days salary. So years of service, how many years you have been completed there? So you have been completed 6 years. Okay, and to put 6 years, you can get certain amount. So out of these three, you have to take whichever is less. So this is the exemption portion. Finally, we can get the taxable portion of gratuity. The next one is this is covered. Sorry, this is covered. This is not covered. So not covered. The as usual provision, graduate received less exemption, actual statute limit. Only one item is changed. This is half month salary. So half month salary, here we have to take half month salary. Half month salary is you have to take for the basic pay, DA and commission. So you can average as usual half month salary into completed years of service. Into how many years you have been completed in that particular organization, that you have to take into account. So this is called tax imposition. So this half month salary is totally different from covered by the Payment of Gratuity Act. The next profit in lieu of salary is pension. So pension, as usual, it's a lump sum amount. It's a huge amount the employees he will be received at the time of retirement, at the time of VRS. So pension, there are two types of pension. One is commuted, another one is uncommuted. So uncommuted pension, it is a periodical pension. Uncommuted pension, it's a periodical pension, or we are saying it's a monthly pension. So you know the government employees or private employees, they are receiving monthly pension from the organizations. The government employee, they are receiving from the government, they are getting monthly pension. So it is taxable. Both government and non-government, private employees, both government and non-government employees, it is taxable. You are receiving pensions per month, it is taxable. That's all. Periodical payments. We are saying it's a periodical payment. So commuted, it's a lump sum amount you are receiving at the time of retirement or at the time of death. So commuted pension, you're receiving commuted pension. So lump sum amount you're receiving from the government. So government, they are giving they are giving to the government employee. That pension is fully exempted from tax. Fully exempted from tax. Non-government employees, private employees, those who are receiving commuted pension, lump sum amount, and that amount. So suppose already he has received gratuity now, the exemption portion is 1/3 of commuted pension. Already he is not get any gratuity from the previous employer or that particular organization. The taxable portion, the exemption portion is off of commuted pension is exempted. Actually, it's a huge topic, but I have to, due to time constraints, I have restricted the next one is leave set. You are working in an organization, your organization is providing leave to you. You are not taking leave. You have accumulated your leaves. You can surrender your leave to the employer. So employer is giving salary to you. You have surrendered your leave. You can get leave. So that we are saying it's a leave encashment. We are saying it's a leave encashment. Leave encashment, you have to surrender your leave. You can get the benefit from the employer, that is cash, that is leave encashment. That is, we are saying it's a leave encashment. So leave salary, suppose you can get during working hours, during working period, during service. It is fully taxable. For government or non-government employee, it is fully taxable. So employees, they are encashing leaves during his service. It is fully taxable. After retirement, employees, they are receiving leave encashment after retirement. Suppose if it's a government employee, it is fully exempted. You need not pay tax to the government. Suppose you are a government employee, you do not pay to the tax to the company. For other employees here, private employees are there. So what is the actual amount you are receiving? What is the exemption portion? Portion is 3 lakhs. So here you have to take 10 months average salary. 10 months average salary, you have to take the basic pay, TA commission. So for the last 10 months, you have to take for the last 10 months, divided by 10, you can get average salary. That average salary you have taken into account. So out of 3, you have to take whichever is less, that is leave salary. That is the leave salary portion. The next 4th important component is PAYEX. PAYEX received by an employee by way of kind or by way of cash. So I have taken only 2 perquisites. One is fully exempted perquisites. So these perquisites you are receiving, that is fully exempted. You need not pay tax to the government. So some perquisites are fully taxable, which comes under the fully taxable category. The first one is fully exempted perquisites. Now we are going to see fully exempted perquisites. So reimbursement of medical expenditure. So you are taking treatment. So fully exempted, you need not taken for salary calculation. So employee was taken in the treatment, medical treatment was taken in the private hospital. Sorry, medical treatment was taken in the employer's owned hospital. It is fully exempted from tax. The employees was taken treatment in the state government or central government hospital. It is fully exempted. Suppose you are taking a treatment in the private hospital, your exemption limit is 15,000 rupees. Your exemption limit is 15,000 rupees. So that should be reimbursed by your employer. So you're receiving certain amount from the employer. That amount, the maximum exemption is given by the government is 50,000 rupees. That 15,000 you have to deduct the remaining. Suppose the particular officer he is receiving 1 lakh from the he is taking the medical expenses incurred by a particular officer is 1 lakh. That 1 lakh is reimbursed by the employer to an associate. So it is income for an officer. 15,000 is exempted from that particular income. So you have to pay 85,000 rupees as tax calculation. The next one is medical insurance premium that is paid by the employer on behalf of the employee. It is fully exempted. So free refreshment. So tea, coffee, it is provided by an employer during office hour. It is fully exempted. It is also so free mobiles. So certain companies, they are giving free mobiles to an employees. That is fully exempted. Free rations provided for members of armed forces. So armed forces members are there. They are getting free rations from the government. That is fully exempted. So rent-free accommodation provided by the judges of High Court and the Supreme Court, it is also fully exempted. Already we have been discussed. So rent-free accommodation for the members of Lok Sabha. So MLAs are there, MPs are there. So they are getting, they are eligible. Already know government is providing rent-free accommodation to them. So that is fully exempted. They are not pay tax to the government. So because they are providing service to the government. So free laptop and computers provided to an employee during office hours. Office hours, they are giving free laptop to the workers. Free cars provided from home to office, office to home. So this is also fully exempted perquisites. The next one is fully taxable perquisites for all employees. So what are the taxable perquisites? So employer is providing rent-free house. So there are two houses. One is unfurnished house. They are giving only house only. They are giving house only. So it is taxable based on the population of that particular area. Rent-free house. The next one is rent-free furnished house. So house plus they are giving furnitures to an employee. Furnished house. The next one is the employee's obligation met by the employees. Employees' obligation, for example, they are giving house, they are giving furniture, their employee, they are giving, they can appoint a gardener to maintain the garden of the house. They can appoint house servant. They are giving gas. They are giving free electricity. They are giving water to an employee. So these are comes under the perquisites. It is fully taxable. It is fully taxable. Free food and beverages provided by employee to employee, free touring, traveling accommodations, free credit card, gift vouchers. So these are comes under the taxable perquisites. So you should know these. So a lot of items are there. Just I have given a few points to you. So the four components are over. The first allowance is over. So allowances, you have to keep the three partly taxable allowances. The next one is we have the provident fund. You keep remaining recognized provident fund. The third one is the profit in lieu of salary. So gratuity, pension, and leave salaries are there. The last one is perquisites. You have remain these two perquisites, fully exempted and fully taxable. So deduction, already you know the standard deduction. It is last year Nirmala Sitharaman, our finance minister, has fixed as 50,000 rupees. So you are eligible for standard deduction is 50,000 rupees. You can deduct from your gross salary. So our salary, taxable salary is come down. That's one. So next one is a deduction for entertainment allowance. It is applicable to the government employees. So taxable portion of government entertainment allowance only for applicable to the government employees. So what is the entertainment allowances? Suppose if it is received by a private employee, what is the taxable provision? The taxable, it is fully taxable. If it is received by a private employee, it is fully taxable. If it is a government employee, the deduction is there. So what is the actual amount? So statute limit is 5,000, 1/5 of basic pay. Here you have to take basic pay. You can calculate 1/5. Then you can put into you can put into exemption pot. So out of these three, you have to take whichever is less, then you have to deduct. So that is called this is deduction. Out of three, you have to take whichever is less, that is the deduction part, you have to deduct it. That's all. So deduction for professional tax, already knows a professional tax paid by each and every employee for the welfare of panchayat, for welfare of the rural, for welfare of the panchayat people, for welfare of the rural people. So it is also comes under the deduction part. So these three deductions is available. So this deduction comes under section 60. So this is the last slide. Taxpayers in India, my dear students. So we are having nearly 125 crores, 125 crores populations. But the taxpayers are 1.9 percentage. So the revenue is generating by the government of India from this 1.9 crores people. So total 26% of the tax revenue is received from 23,932 people. So they are giving their contribution is 26%. The remaining, that is 0.19%. The remaining rest of the percentage, 99.999%. So their contribution is the remaining 74%, my dear students. Still, I already told you 95% of the people in rural India, in semi-urban area, their income is below exemption limit. This is below 2,50,000 rupees. So my humble request is you have to pay your tax to the government. Government is generating revenue through tax only. This tax used by the government for the public welfare. So, Mansi Madam, thank you for the opportunity given to me.
Thank you so much,
Any
sir.
suggestion, any query, please ask me.
Yeah, there are some questions from the viewers if you'd like to answer them.
Yes, ma'am.
So, according to you, which tax regime is better, the old one or the new one?
Madam, I couldn't get your voice. Please louder.
So the question is, according to you, which tax regime is a better one, the old one or the new one?
The tax, it is in the hands of employees, madam. That there are two tax rates. The old tax rate system is there, new tax rate system is there. In old tax rate system, so 80C and 80D is you are eligible. 80C is the deductions. So you can deduct, you can show your deduction up to rupees 1,50,000 rupees. You can show your deduction up to rupees 1,50,000. Suppose you can get loan from the bank for your construction. So you can pay interest and the principal amount. You can show as a deduction under 80C. So according to me, the old tax rate system is a useful one.
Okay. The next question is that if any employee receives any gift from the employer, so will it be calculated in the salary?
Yeah, gift if exceeds rupees 5,000 rupees, you have to pay tax. So which is taxable under the head income from other sources. It is not comes under here. It is taxable under the head income from other sources. So I already told you 5 heads of income. This fifth heads of income, it is taxable. So the total gift. So for example, you are receiving gift from your employer. If exceeds rupees 5,000, you have to pay tax to the government. The gift from your sister, you are exempted. You are receiving gift from your marriage, you are exempted. You are receiving from your gift from your friend, it is taxable. You are receiving a gift from your brother, it is exempted. The total exemption of gift is up to 50,000 rupees. Up to 50. If it exceeds 50,000 rupees, you have to pay tax to the government, but it is not taxable under the salary. It is taxable under the income from other sources.
Sir, thank you so much for sharing your knowledge and giving your time to us. I'm sure now our students will be able to compute salary and tax on it with a clear mind. Thank you so much, sir, for the webinar.
Thank you, madam. Thank you. Thank you for inviting me. Thank you. Please keep on touch with me. Thank you. Thank you.
Yeah, thank you, sir.
Thank you.